Well, let's get some global perspective. Taimur Baig is Managing Director and Chief Economist at DPS Group. And Mark Matthews of Bank Julius, Baer and companies with us as well. Gentlemen, good morning. Great to have both of you here. Prashant this side. Thanks once again for being here on CNBC. Taimur, again, it's a lot into the mix, right? But generally, markets have been pretty buoyant, especially the US market and markets here in India as well. With what we are seeing, especially on two fronts. One is, of course, this entire inflation bit in the US, and now this geopolitical tensions, etc. Do you think it can spoil the narrative, or things look quite okay? Taimur.
Right. So this reminds me of days in 2018, 2019, when we used to say that it's not one punch. You need multiple punches for the market to sober down. And we ultimately needed basically the COVID pandemic to really bring the markets down. That, of course, it turned around vigorously when policy response came through. So I think we're in a similar situation, which is that we thought that high rates was going to spoil the markets at a time when you have very large yield gap. There's not much motivation to hold equities, but looks like there's plenty of enthusiasm, optimism, and still lingering effects of the substantial liquidity injection. So it would take more than little skirmish in the Middle East, where 99% of the missiles get shot down. So it's not really a major conflagration. It's a escalate to de-escalate type situation. And the clear risk element around Middle East is energy, and energy is so well supplied around the world right now, with substantial excess capacity in the Middle East and the United States. So to me, this particular event is not sufficient to push the ever ebullient market to a downward spiral.
Oh, okay. That's good to hear. Well, Mark Matthews is also with us from Bank Julius Baer. Mark, would you concur that this kind of a skirmish may not be the reason for a major sell-off in global equities? Or are you a bit worried now? Now, worried I ask because there are so many internals which suggest a risk-off, right? Whether it's gold prices moving higher, large buying from central banks in gold, the US 10-year yield shooting up, crude shooting up. Would you be concerned about equities now?
I would concur that this event in the Middle East is not going to take down the market. If you look at the previous 50-odd kind of shocks like this since World War II, it's clear the ones that do take the market down are the ones that have an economic impact, like the Yom Kippur War and the oil embargo in 1973. But then other ones, like when John Kennedy was assassinated in 1963, the S&P was 20% higher a year later because there was no economic impact. So the big question is, will there be an economic impact? And so far, oil is trading very well, as Taimur said. I think in about 3 months, Iran will be attacked by Israel because it's very expensive to operate the Iron Dome. Probably cost Israel upward of $1.5 billion yesterday, or Saturday, to shoot down all those drones and missiles. They can't keep doing that forever, and they do want to send a message. They think messaging is as important as action in the Middle East. And so when they do that, I don't think they'll hit any civilian targets, but I think they'll take the military targets, the infrastructure in Iran back about 30 years, which is what they did in Iraq and Syria previously. Then we'll have to see how the market reacts to that. That's a few months from now. But as it is now, I don't think this will have an impact. And you mentioned a whole bunch of other things as well, gold prices and interest rates. I'll just say that, and to Taimur's point, the important thing is that actually the growth is good in the world and the United States. And if we do get earnings for the S&P of around 10% this year, then, and the consensus looks for a similar number in 2025, I struggle to see stocks going down.
Okay, all right. Thanks for that, Mark, and good to see you. Well, Taimur, I had a question for you. Good to know that both of you gentlemen believe that what's going on currently in terms of geopolitics will not affect the equity markets at least. But Taimur, I wanted to ask you about, we've got a lot of economic data that's come out, say in the last week or so. The jobs report came out, you had the inflation number, and then you had consumer sentiment that took a bit of a hit. Given all this economic data that's coming out of the United States, What are you expecting from the Fed for the remainder of this year? How many rate cuts and what quantum?
Right. I'm actually speaking to you from the United States. I'm actually in New York City right now. The mood as far as company earnings, the tailwind from the stimulus, the huge infrastructure spending, those things are substantial. On the margin, of course, there is some worry that the last few inflation data prints have been indicative of stickiness of inflation, that the journey toward 2% is difficult, and also from a consumer sentiment perspective, petrol pump prices going up a tad, rental prices firming up again, housing supply remaining tight, those things don't help. But the fact of the matter is today's oil price is in real terms the same as it was 20 years ago. And I think we can all safely conclude that during the 20 years, the purchasing capacity of the Americans and the rest of the world has gone up substantially. So the ability to absorb higher energy prices, I think, is substantial. The ability to absorb high interest rate in the United States is substantial because there are very long duration debt products out there, including 30-year mortgages. People who took that 3 years ago don't have to worry about this interest rate cycle at all. So I think overall, the marginal concern with the economic data with respect to inflation or geopolitical tension, I think don't help. But the stock of strength, fundamentals based, is substantial.
A final question to you then, Mark, before we let you go. How would you summarize all of this? If there is a dip, right, just because of large risk aversion globally, is this a good time to be putting money to work in a market like India? Because we're headed into a huge election season as well. What are your thoughts?
Well, that depends how you quantify dip. Is that 1% or 20%? Right now, I would say for sure this is not a risk-on event. And the markets are treading water, and we'll need a few days to sort of figure out where we go from here. I wouldn't be a buyer unless there was a substantial dip, to answer your question.
You wouldn't be a buyer. Got that. Well, just have to wait and watch, I guess, which way things go, right? Taimur and Mark, thank you so much for joining us. Appreciate your time as always here on CNBC TV 18.